New candles appear in different shapes and sizes in stock charts every day. But do you know that these candles, when formed in certain shape and patterns, could signal to you a potential change or continuation in trend? In fact, there are some traders and investors who even base their trades or investment on them. Today, I'm going to go through with you 18 important candlestick patterns that you could commonly spot in the charts and the psychology or the hidden story behind these patterns that made them effective. Firstly, let us recap the basics of candlesticks. On the left here, we have a bullish candle. When you see this, you will know that the stock prices have went up during the day. So generally, what happened is that the price would open somewhere low and make a low during the day, and subsequently went up higher all the way to make a high here, and finally close at a price that is higher than the opening price. So this is what happened in a bullish candle. So on the other side, we have the bearish candle, and this time the prices open high, make a high during the day, and it come down all the way to make a low and then close lower than where it opens. So when we see this, we will know that the day itself is a bearish day. So can you see how powerful candlesticks can be? Just one alone summarizes what has happened during the day and all the information that you need, the high, low, open and close of the day. And when you put different candles together, they may signal to you the probability of something that may be brewing in the markets. You can then base your actions on these candlestick patterns, be it as a trade or as an investment. Candlesticks come in different shapes and sizes. Here are two of the more unique forms of candles that have special names given to them. When you see a candle with a long shadow and a narrow body or almost no body, we call them a doji. The body could either be in the middle of the candle or at the bottom or near the top. The fact that they have no candle body tells you that the prices open and close at almost the same level that day. And then we have the second type of candles called the pin bars. For this, they have a small body, and like the doji, they have a long upper or lower shadow. So this definition that I have given must have left you confused. If not, could you tell me which of these three candles is or are pin bars? Now if you ask me, only the middle one is what I would call a pin bar. So let's give a better definition. To be considered a pin bar, the longer half of the shadow should at least be 2/3 of the entire candle's length. Given this definition, certain dojis are considered pin bars as well, as long as the longer part of the shadow is 2/3 of the entire length. The reason why I'm going to such lengths to tell you all this is because pin bars tell us a great deal of story, and by themselves they form a powerful candlestick pattern which you are going to find out in a while. Candlestick patterns are split into two types. The first one is the reversal candlestick pattern. These signal a potential change in trend, either from a downtrend to uptrend or from an uptrend to a downtrend. For example, you have a downtrend, and then you encounter this certain type of reversal candlestick pattern. It will then signal to you that this is likely the bottom and that a trend reversal is about to come. The second type is continuation candlestick pattern, which signals that the preceding trend is likely to continue. For this, they appear in the middle of a continuing uptrend or a downtrend. And when you see this pattern forming, it tells you that the previous trend is likely to continue after the pattern has been completed. So this pattern, they appear in the middle of the current trend as brief period of rest or consolidation of stock prices. Most of the patterns that we are discussing today will fall under the reversal pattern category. And the first one that we have is none other than the bullish pin bar. Now you may be wondering, why is this candle black in color? Recall that a green candle is a bullish candle and a red candle is a bearish one. But for this candlestick pattern, the shape of the candle is more important than the color of the candle body. The candle can be any color, red or green, but what you want to see is this small bodied candle with a long lower shadow, and we will call this a bullish pin bar. The shape is important because it tells us that on this day, the initial usual bearishness on the downtrend is intact. But halfway throughout the day, the bulls have taken control over the market and is driving prices all the way up to where it opens, therefore giving us a small bodied candle. This will signal to us that a potential change in trend is about to happen, whereby the bull is now stronger than the bears. And we will expect to see another bullish candle forming the next day for confirmation of the reversal upwards. The opposite is also true. For a bearish pin bar, we want to see a small body candle with a long upper shadow, be it red or green bodied. And this should appear at the top of an uptrend. This will tell us that within the day itself, the bear have overpowered the bulls and gained control of the market, and that the bears have the power to push prices back down to where it has opened. And with this, we will anticipate a potential change in trend, and we would like to see a bearish candle forming the next day to confirm that the reversal has indeed occurred. The second pattern that I have for you guys is the tweezer bottom. For this, the downtrend is ongoing as usual, and on the next day, you see a bullish candle that is almost the same size as the bearish candle that appeared previously. For those of you who are sharp enough, you will notice that this is actually a bullish pin bar played throughout 2 days. So on the first day, the prices went down and closed over here. But on the second day, prices opened where the previous day closed. And this time, the bulls have taken control over the market and pushed prices back up to where it was and closed back at the previous day open, giving us a pseudo bullish pin bar. For this pattern, what is important is that the two candles should open and close at similar prices from each other. As usual, when things go the other way around, that will give you the bearish version of this pattern, the tweezer top. On an uptrend, you have a continuation of a bullish candle that forms. However, on the next day, the prices open where it closes and went back down to where it opened the previous day. And this gives you a bearish pin bar. And subsequently, prices are expected to move downwards from there on. The third pattern that we have is the morning star. On a usual downtrend, we have a red bearish candle forming, and on the next day, we have a gap down. Now notice the disconnect between the prices between these 2 days. This gap is important because it tells us that the downtrend is continuing strong and signify the weakness in the market. But throughout the day, there isn't much price movement at all, which results in this relatively smaller candle where its color doesn't matter. Upon seeing this pattern, the candles are telling us that on this day, the market participants are uncertain as to where prices should go on the day itself. The next day, if we again see a gap up with a regular size bullish candle, this will signal to us that the trend is likely to have reversed. To have an effective pattern, we would like to see this bullish candle closing above the 50% mark of the first bearish candle that formed. And for the bearish version of this pattern, we have the evening star. And then we have a similar variant of the morning star, which is called the piercing line. In the morning star, there was a day of indecisiveness from the market participants. But for this, prices get down to show the initial market weakness. But throughout the rest of the day, the prices just keep going up and close at least 50% of the previous bearish candle body. This acts as a significant blow to the bearish mentality and may force many to exit their short position, causing prices to continue higher. As usual, we would like to see another bullish candle forming to validate the change in trend. So the bearish version of this pattern is called the dark cloud cover. And again, you have just things played out in the opposite direction. In more extreme cases, you will then see this pattern called the bullish engulfing. Same scenario as the piercing line, but even more bullishness on the reversal, such that the bullish candle closes above the body of the bearish candle. And we say that the bullish candle has engulfed the bearish candle. The psychology behind this pattern is largely the same as the piercing line, except more extreme. And on the bearish side, you will observe a bearish engulfing pattern. Next up, we have something new. This bullish reversal pattern is called the one white soldier. This pattern starts off usually like all other patterns, with a bearish candle that continues the current downtrend, but for the next day, prices open higher, signifying some strength. And this strength is enhanced by the bulls gaining control over the market, resulting in a bullish candle that closes above the body of the bearish candle. With this, we will expect that a reverse in trend has likely happened, and we would like to see another bullish candle to validate this trend reversal signal. The bearish version of this pattern is called the one black crow, with everything happening the other way around. Now, if the one white soldier is not enough to convince you that a trend reversal has occurred, you could wait for more confirmation, and this will give you the three white soldier. For this, you want to see 3 consecutive bullish candles, one after the other, each leading to a higher high. Personally, I seldom use this, as by the time I observe this pattern, prices will have moved up far too much and make the setup or opportunity undesirable for trade and investments. So the opposite for this is just the 3 black crow, and with that, we move on to look at some continuation candlestick pattern. So the first continuation pattern that we have is the bullish 3-line strike. It starts off with 3 bullish candles, similar to the 3 white soldiers that we have encountered previously, each closing progressively higher to give you a higher high. And finally followed by a bearish strike candle. So the strike candle should start somewhere near the close of the 3rd bullish candle and should cover at least the entire range of the 3 bullish candles. This strike candle is seen as a temporary correction or a pullback and is a reaction to the strong upwards move by the 3 bullish candles. Oftentimes, there will be a lack of commitment to follow the bearish sentiment through, and therefore we anticipate the trend to continue in the direction of the first 3 candles afterwards. So the opposite of this, which is the bearish continuation pattern, is the bearish 3-line strike. And as expected, you'll see everything in reverse. A 3 black crow followed by a bullish strike candle that should cover at least the entire range of the 3 bearish candles. And with this, we likely anticipate the downtrend to continue on afterwards. The second continuation pattern, and also the last pattern that we have for today, is the rising 3 method. In this pattern, you observe 3 consecutive bearish candles forming higher lows during a normal usual uptrend. What's important here is that these 3 red candles are relatively smaller in size compared to the other candles in the chart, and that these 3 bearish candles are contained within the range of the first bullish candle. So this can be seen as a period of rest from the bull, and when you see the last bullish candle opening and closing above the first bullish candle, you know that there is a lack of commitment from the bears to follow the bearish sentiment through. At this point, the bulls have regained control of the market and the uptrend continues. And finally, bearish version of this pattern is called the falling 3 method. Alright, let's put everything to practice now. From this chart, could you identify some of the candlestick patterns that we have just gone through? Firstly, do you manage to spot a morning star here? As a bullish reversal pattern, stock prices reversed and went upwards after this pattern has formed. Also, do you see a gigantic 1 white soldier that appeared over here? After the formation of the 1 white soldier and the confirmation candle, prices have went up all the way very strongly. Do you also see another 1 white soldier that has formed over here? So of course, when it comes to technical analysis, always remember that this is a probability game. Spotting a pattern does not mean that the trend will definitely play out as expected. Otherwise, everyone would be rich and successful here, right? For example, you can see a bullish pin bar over here that didn't play out as planned. Prices went up slightly and then fell shortly afterwards. As well as this 1 black crow that did not play out well in this instance. As a bearish reversal candle signaling a reversal from an uptrend to a downtrend, it certainly did not play out accordingly. So here comes the important question. How can we improve the probability of signals provided by these candlestick patterns? The trick is this. You only want to consider these patterns when they appear on strong support and resistances, especially for reversal patterns, because reversals frequently occur at these areas. If you are not familiar with trends and how to identify effective support and resistances, I strongly urge you to go through my tutorial on these topics. Links in the description below. Otherwise, let us head into some examples. So this is the daily chart for the SPY, the S&P 500 ETF that tracks the US broad market. And you should already be familiar with what these lines represent: the 20 EMA, 40 EMA, 150, the 50 SMA, 100 SMA, 150 SMA, and 200 SMA. You should also be well familiarized with how to draw horizontal support and resistances, as well as up and down trending trend lines. So as previously discussed, we have seen that the price for the SPY has bounced off the 150 moving average once here, And upon visiting it and bouncing it off the second time, we are now certain that the 150 simple moving average is a strong moving average support. And therefore, we would like to spot bullish reversal candlestick patterns that occurred at this potential supporting moving average that gives us further confidence that the price will likely reverse and bounce off the 150 moving average. So likewise, can you see a bullish pin bar that occurs over here that cuts through the 150 SMA and also appearing very close to the uptrending trend line that I have drawn. And the second bullish reversal candlestick pattern can be found here. Again on the 150 SMA, we have a piercing line. After seeing these two bullish reversal candlestick pattern appearing on a strong support, the 150 moving average, it will give me the confidence to anticipate a likely change in trend. From a short-term downtrend, it should likely bounce off soon to give me a short-term uptrend. And as a trader, I would be inclined to take a trade over at this point over here and place my stop loss and take profit targets as per my trading rule and setup. As an investor, I also have likely gained the confidence that the stock prices have found a near-term bottom over here at the 150 moving average with two consecutive bullish reversal candle appearing. It will give me the signal to dollar cost average at this point in time for my long-term investment portfolio. Next, you could also see a very tiny bearish pin bar over here at the horizontal resistance that I've identified. And what's more, this horizontal resistance has been tested once previously, that the prices visits it again, and it will give me added confidence along with the bearish reversal candlestick pattern that prices is likely to have reversed from a short-term uptrend to now a short-term downtrend. And again, if I'm in a long position, I could take this signal as an early exit to capture all my profits. If I'm an aggressive trader, I may take a counter trend trade and short the market down. After that, again, can you see two consecutive bullish pin bar that appears on the same horizontal resistance that I've identified previously? This time, prices have broken through, and this line should now act as a horizontal support. And true enough, prices on two consecutive days form a bullish pin bar that pierces through this horizontal support. It tells me that on these two consecutive days, the bears in the market push to drive prices down, but on both days, the bulls have taken control and overpowered the bears, resulting in prices closing back where it opens. And sure enough, after this, the prices have resumed their uptrend upwards. Now, having said that, those of you who are sharp enough will point out that these two bullish pin bar did not occur at the bottom of a downtrend. For this, the preceding trend has been upwards, and stock prices has been in somewhat of a consolidation for 4 days, with the two bullish pin bar appearing before the price continued to take off. If you have spotted this, good for you. In situations like this, the strength of the bullish pin bar will not be as strong as compared to if you have this forming in the bottom of a downtrend, which signals a potential bottom and a likely reversal in trend upwards. So likewise, you can see that this bullish pin bar as well did not occur on the bottom of a downtrend. So while you're analyzing the stock chart, you would want to ignore candlestick patterns like this. With this, I hope you have gained something new to stay afloat and gain an edge in the market today. Drop your burning questions in the comment below and smash that like and subscribe button. Thank you for watching and see you next time.